Hey, this is Matt from InvestiQuant. Today is Tuesday, October 27th, 2020. Yesterday, we saw a big down day in the market. It was a sizable sell-off where we had a gap and go day lower. We did end up rallying into the close, but the majority of the day was gap and go lower, where we gapped down and then pressed lower about 75 points of range in yesterday's S&P session before we ended up bouncing as we approached the close. But what I want to do this morning is take a look at what has happened after a gap and go type day like that, where we gap down and push lower to a new closing low. And then in the next overnight session, we start to lift a little bit like we're doing right now. So let me set this up and discover. We're going to look at all four instruments. The setup's based upon getting long at the open, which is 9:30 a.m. Eastern Time, exiting at the close, which is 4:15 p.m. Eastern Time. Now, currently, the overnight session has been fairly quiet. It's just kind of balancing a little bit higher, but it is trading higher within the prior day range. So I'm selecting gap up within the prior day range for the opening direction for this pattern. Next, I'm going to go into the price patterns, and I'm going to set up this gap and go like activity. The way I'm going to do that is I'm just going to look at this active today section and click on a couple items. The first one is day after an unfilled down gap. So that kind of gets the gap down activity from yesterday that never made it back to prior day close. And then it also closed at a 10-day low close. So those two things together kind of make a gap and go like pattern. And then I'm going to go into the indicator section, and I'm going to say that we are below a 10-day simple moving average, but above a 200-day simple moving average. Then I'm going to hit view results. And here we go. So these are the results of going long when you open up within the prior day range following this gap and go like day, which I've described as an unfilled down gap that closed at a 10-day low. This is taking place below a 10-day moving average, but above a 200-day simple moving average. Historically, dating back to 2003, the S&P has seen this pattern happen 69 times. The NASDAQ has 63 samples, the Dow 65 samples, and the Russell 73 samples. If we look at the win rates on these, the S&P coming in at about 51%, so fairly mild. The NASDAQ a little bit better, about 56%. The Dow, 52%, and the Russell, 56%. So all four of these neutral to slightly favored. None of them have weak win rates. They are neutral or slightly favored here. And then if we look at the average win to average loss, the average loss larger than the average win in the S&P. That is also true in the NASDAQ, the average loss quite a bit larger than the average win. That's also true in the Dow. Average loss larger than the average win. And lastly, in the Russell as well. So the average loss there almost twice the size of the average win. So all four of these instruments have win rates that are at least neutral or slightly favored. But historically, the average loss on all of them is quite a bit larger than the average win. So it's not necessarily a weak pattern that says you want to be getting short, but the bigger risk has been on the downside historically following this pattern. And that's why if you look at the equity curve here, you can see they're all kind of just moving lower. It's a choppy fashion, but you've got win rates that are neutral to slightly favored, but the equity curves are all pointing lower, and that's thanks to the average loss being quite a bit larger than the average win there. So hopefully you found that helpful. Good luck today, and we will see you next time.